Income investing has become increasingly complex over the last few years as investors has navigated inflation shocks, shifting central bank policy, and changing risk premia. The Nedgroup Investments Flexible Income Fund, managed by Lara Dalmeyer and the AVAX team, seeks to preserve capital while delivering attractive risk-adjusted returns in a conservative manner. Lara, looking at fund performance, SA Fixed Income Assets has had an exceptional first quarter and year. What has driven the strong performance of the last year or so?
Yeah, fixed income assets have had an incredible year. Last year was very strong. You saw a bit of a weaker Q1, and then Q2 you had that strong rebound again. So it continues to largely be a local nominal bond story. South African government bonds continue to perform exceptionally well. So yeah, if you look at the contribution to return of the fund, very little of the fund is being delivered from offshore exposure. And I think now, but we'll get into this when we discuss later, there's actually seems to be a bit more attractiveness in the offshore market at the moment. But local nominal bonds, again, that steepness in the curve continues to flatten. And yeah, even as markets are pricing in additional hike expectations, you know, the bonds continue to defy that. I think everyone's got a very positive SA outlook, so that risk premium just keeps compressing. So again, it's really just been a local nominal bond story. This quarter, you have actually also seen inflation-linked bonds perform quite well. And naturally, the fund has a very large floating rate component, which consistently delivers returns for the fund. But that is a much more stable yield underpin for the portfolio.
Yeah, I want to get onto that point of floating rate exposure. We can see it's contributed meaningfully to fund performance. Can you explain why these exposures has worked so well in this environment?
Well, that is ultimately for us our favorite asset class. It's what we try and invest as much of the fund in as possible. Naturally, we've got complete control over the credit risk portion of that portfolio, and we look for high quality credit. We don't really play the high yield credit space. And where we find opportunities that you are getting a good spread over Zeronia or JIBAR, now obviously there's been that transition, that for us is for lack of a better word, a no-brainer. Because you are giving the fund that excess spread. It accrues so in quite a stable and consistent manner because you don't have the duration like you do in the fixed rate instruments. And yeah, it continues to just perform well and give the fund that stability and consistency that we all know well. So while it's not going to be volatile like the bonds and give you those big, amazing quarters, it will just be there very consistently.
This time last year, I think we were on the verge of a downward cycle. Yeah. Very much has changed this year. We've had one hike already. You know, higher for longer seems to be the current thinking. What is the most important assumption underpinning your current positioning?
So globally, the environment is a lot more inflationary than what it was last year, and that's largely off the back of the oil price. I think, however, perhaps incorrectly, people can think that it's just a once-off hit and on headline inflation, and it should subside back down to usual pretty quickly. There is a degree of truth of that, but I think people underestimate how persistent these shocks can present in inflation numbers. So you have what you call second round effects, which means for a while it affects what we pay for food prices, what people are being paid for transport prices. So yes, while you have this big shock in headline, you can also see elements of come through longer in headline and also even in core inflation. So at the moment, our most recent print on inflation was 4.5%. We will have a print later this week in June, and that market is expecting to be about 4.7%. Now the June meeting is the day after that, and now the market is seeming to think that it is going to be a hike. It's like just more than 50% chance from pricing that it's going to be a hike. But if it is not a hike now, it will all likelihood be a hike later. So let's say the most dovish outcome in this meeting will be a hawkish hold. But to the end of the year, the market, and we agree, are looking between 1 and 2 hikes still to come. But you're seeing that in a lot of markets around the world. If you look at the US as well, for example, and there you can see what the US market is pricing for rates, for what rates will be in December this year. And you can see they are also expecting hikes from here. But the US market has also become a bit harder, a little bit more volatile, because now that forward guidance that we were so used to under Powell is no longer the case. But it is very safe to say that the cutting cycle we were seeing 6 months ago versus, let's say, what we're seeing now, and that chart is good to the end of June, it's a very, very different environment.
Indeed, we can see from the forward rate curve where it was pricing 6 months ago to where it is now. And you mentioned, that hawkish hold. Do you think the market is correct in how it's pricing, more persistent inflation and risk in the market in general?
If anything, I think the market might be underestimating it. And I think maybe that is more true in the US than what it is locally. I find that the break-evens in the US market are very, very low. Real yields in the US are looking quite attractive to us at the moment. But in SA, we're going through like a bit of a transition period where it comes to inflation and inflation target. We have all kind of been used to the 4.5% range, maybe 5%, and we're now in the environment where SARB's trying to go to 3%. And the market is probably having a little bit of difficulty in assessing where more naturally we should or will settle. So I think maybe break-evens locally are a little bit, still maybe a bit on the lower end, but probably a bit more realistic than what we see them to be in the US at the moment.
Yeah. I mean, on the story of SA bonds, they've rallied. I think they're up 4.2% year to date, 21% of 1 year. There's been some bright spots as well. We've seen the upgrade from Fitch. When you look at SA bonds versus the global opportunity, how do you, look at that opportunity against the risks that remain in SA?
So for us, well, let's go back a bit. Local bonds at one stage were looking exceptionally attractive. And we have seen, let's say, over the last 2 years, this phenomenal compression in yield. And it's been off the back of, a really strong turnaround story, we would say, locally. Growth prospects were looking a lot better. I think from a fiscal point of view, National Treasury's done a lot in order to buy credibility from the market. So it was a really good positive story. Now, however, you're starting from quite a low entry point. The 10-year at the end of June was 8.5. Today it's trading a little bit higher at about 8.7. But there are two things here, or two things that kind of we evaluate when looking at how we feel about bonds. Firstly, where are our bonds trading relative to global markets, particularly developed markets like the US, because you do need some kind of risk compensation for being in SA bonds versus US Treasuries. And secondly, what is that implied risk premium? What is that spread? And if that spread is very, very low, like we seem to think it is at the moment, you've got to start asking whether it's maybe worth your while to not rather hold, let's say, and take this with a pinch of salt, because I know there's a very large debate around this as well, but into essentially the global risk-free asset. Do you move that, your cash there rather? And for a very long time, that difference was so big. But now, it's at like multi-decade lows. If you look at where the SA 10-year is trading versus the US 10-year, that is a very, very low differential at the moment. So we're seeing something very interesting. Global base rates are actually, there's a lot of upward pressure, and upward pressure for good reason. There is a huge amount of US Treasury issuance. There is a large fiscal incredibility. And I think people are starting, or markets are starting to worry about that. So yes, global base rates are rising, real rates are rising, but you've seen this incredible compression locally. So you've got to ask yourself how sustainable that is, particularly off the back of the fact that this is a risk premium compression. And if you look at my chart here on the left, there are a few like idiosyncratic things that's worth pointing out in this chart. It's looking at backward inflation, not forward inflation, etc. But the story remains the same, that you have seen this incredible grind lower of the risk premium embedded in local bonds. Yes, you've had the fundamental turnaround to some degree, but there is also a more global narrative around that credit spreads globally, high yield credit spreads, are at multi-decade lows. The market in general is just not providing that much premium on credit. But we also need to ask how sustainable that is. In our opinion, it is not. And you also need to ask whether you want to be holding assets of risk at those very low levels of compensation. We also just need to maybe, do a little bit of a fundamental reality check where the growth numbers that we were seeing a few months ago are unfortunately highly unlikely. We are still maybe 1.7% real GDP growth at best, I reckon, for the next few years. If you look at domestic demand, and I've put the chart up there, it fell off a cliff in Q1 2026. You can see the local consumer is under considerable pressure. And while we got away with a lot of the local noise, political noise this last quarter around immigrants and protests, I think that may continue, and we need to remember that there's a local election coming. So this, so maybe perhaps over-relaxation of the market, we would be a little bit cautious of at this point in time.
Of course, and we know, you and Phil manage the fund in a very conservative manner, so right, looking to preserve capital rather than just going, gung-ho, looking for yield, yeah. Yes. I just want to pull on the thread that you mentioned, with the SA 10-year at 8.5%, how much of that return should investors view as genuine yield, and how much should they view as compensation for uncertainty?
I think there's very little compensation for uncertainty at the moment. I think there should be a little bit more. So yeah, I think that, again, those spreads are just very compressed. And, it's also worth noting just how different our yield curves look these days. I mean, you've got about a 1.2, 1.3% spread between your short-dated government bond and your ultra-long-dated government bond. I mean, we used to have, this incredible steepness in our curve. Now look how incredibly flat it is. Break-evens are, at the short end, are not incredibly attractive, but they're reasonable. But where we used to see those very, very high break-evens on the long end of the linker curve, those have now come in a lot. So, our government bond yield curves are looking considerably different to what they were 2-3 years ago. So it's a bit of a new environment. And while you've seen this compression, asset swap spread compressions naturally off the back of this, credit spread compressions, it is an environment where I believe good quality yield is quite hard to find.
Yeah, you're not having to take a lot of duration risk, to extract that yield from the market. With that in mind, how is the fund positioned today while managing risk?
So as always, this is an income fund. We never want to give our investors a nasty surprise. We try to position the portfolio so that there is this high degree of consistency in yield, and the yield in the fund at the moment is about 8.2%. And we do that by limiting, firstly, duration risk. And you will see that by just how high a percentage in the fund we have as floating rate exposure. almost 55% of the fund. And that really is where we do most of our hard work, is trying to find floating rate instruments where we can get an attractive spread over cash. Then we would play a little bit of duration, but more conservatively. So we have about 20% in fixed rate bonds, and of that, that would translate into about a 1-year local nominal bond duration. Now you'll notice that is a little bit more, or we had a bit less at the end of the previous quarter than what we do this quarter, and we did buy a bit into last quarter's weakness. So as we saw that weakness in Q1, we built up our duration, and we have subsequently got about 1-year nominal bond duration, but still very conservative. Inflation-linked bonds, relatively less attractive than they were a few months ago, but we still have about 0.2 years ILB duration, and those are all in the short end of the curve. So while you see a 10 or 11% allocation, it's only 0.2 years because they are lower duration instruments just because of the term. And then we have 0.1 years in offshore duration, and that really is only through real yields, treasuries, inflation protected, where, with the 10-year trading at about 2.3% real, that to us is starting to look quite attractive, especially given the fact that we believe that these inflationary pressures will persist a bit longer and a bit higher than what the market is thinking. We try to obviously maintain the hard currency exposure to a manageable degree. If we were to completely leave our offshore exposure unhedged, you would have your fund just being driven by the volatility of the rand. So we do hedge most of that back. And what we leave unhedged is a very deliberate decision. And that acts as a bit of a hedge against our duration. And it would also reflect our view on dollar rand or dollar euro pound, etc. And we have about 2.7% unhedged. So ultimately, you've got a very nice diversified portfolio, not swinging for the fences, just trying to deliver as consistent a yield as possible, with that capital preservation mindset being front and center for our investors, particularly as things become a bit more stretched, and I would say global uncertainty is a lot higher than what we've known for the last few years.
Thanks, Lara. That's a very useful way, I think, to frame it for investors. Meaningful income yield without taking aggressive duration, and then diversification across multiple fixed income building blocks. We'll leave it there for now. Thanks so much. Thanks for your insights.
Thank you.